Great, thank you very much, and welcome to the half-year results. As you would all know, we've released the results of the half-year to the ASX about an hour ago, and I'm pleased today to be giving you a short presentation, but the most important the questions, and we'd like to offer shareholders and interested parties the opportunity the half-year results, and if there is any particular questions you'd like to ask of the results or in respect to our future plans, this is a great opportunity. Welcome, and I'm very pleased as CEO to give this presentation. Just a quick disclaimer, as I've talked about before, this is an important slide for Sequoia, because we are all about advice, and the disclaimers that you often see on these type of public documents are talking about none of the taking into account any of your personal situation, and what we're talking about in respect to financial numbers are general in nature only. So please understand that, but certainly if you ask any questions, we'll certainly be pleased to answer them. I'll slip into what the four subject matters today, and I've talked to shareholders and the group. The Sequoia business is all about with the current landscape in the market. The Royal Commission is now, is not distant memory, but it's 3 or 4 years old, and the advice industry and that is really maturing. The disadvantage that groups like Sequoia had in the past is we were looking to compete on price with organisations that were able to subsidise the cost of advice to their representatives through product. And the Royal Commission has changed that landscape. So we are now in a position to offer services to accountants, financial planners and the broader community using our scale to reduce the cost of advice and provide a whole range of services to that industry. And, for the first time ever, my 35 or 40 years in this particular industry, I think we're finally on a level playing field. And, community with our arms behind our back, but we're relying on a scale and an opportunity environment for the receipt of that advice. So that is really exciting. It's what I'm passionate about. It's probably my life legacy to improve the services to the Australian community that is partial, if you like, from product. And it's all about services, advice, taking into account every client's individual person's circumstances and enabling advisors and accountants and those that provide advice the opportunity to have a successful, profitable business and give the community that's still only advice at 16% of the community a much higher number than that. And that's really important to me and what I'm passionate about. I'll move on to the financial highlights. I'll talk to the first slide, but I'll pass the more detailed slide to Lizzie, our CFO. But the first one, $9.1 million revenue, was a really big jump. I would like to make a point in respect to that. Which would normally have come into the second half in the first half. In our specialist investment product area, we closed out some of those products early. We're concerned the market might have come off in the second half of the financial year. So we spoke to our clients, and that created around about $9 million of revenue that would normally come in the second half to come in the first half. It had really no major impact whatsoever on the EBITDA, but it certainly has a major impact on when our revenues would normally come. We would have got that revenue in the full year. I think it's fair to say that our revenue really is something around 70 million in the first half, and the second half should be higher than that. So we did announce to the market we'd expect a 15% increase in revenue for a full year, but clearly we're going to do much better than that. EBITDA result. The first half of our year is always lower than the in the first half, which basically all converts to cash. So EBITDA and operating net cash flow in our case is almost the same. So we were 800,000 per month in the first half. We've almost got $1 million per month of operating net cash flow. So that's a really good result from our point of view. In the second half, we're more likely, and we're budgeting closer to between $1.2 and $1.3 million per month of operating cash flow and EBITDA. So position in respect to that, the EBITDA margin has reduced, but that's really as a result of that revenue coming in early and the margin being spread over a longer period. Net profit after tax, which is a very important indicator, is up 57% in comparison to the first half last year. But probably the most important number, I think, on that whole slide, 4 cents of operating cash flow per share after tax. And we're looking to and operating cash flow after tax at around 7.5 cents. So that's obviously after paying your 30% or 29% in tax. To 7.5 to 8 cents per share after tax, 10 cents per share before tax, and all of the EBITDA being reflected in cash. And cash is what we're funding the business from. I'll move to the second slide, and I'd like to pass you over to Lizzie because she can go in more detail to this particular slide. So thank you, Lizzie.
Thank you, Gary. Good afternoon to everyone. Just want to provide a quick some sort of financial commentary for the first half results that we report today. As you know, we are reporting a net profit after tax of 2.6 million, a very good result, an increase of 57% first half. The new Sequoia journey started in 2019 with today we have delivered on this promise, and we have been doing it for the last, 5 half years, and we continue to do so. Today we declare an interim dividend of 0.5 cents per share, a 25% increase from last first half. The revenue this half is 79.1 million, up 51%. There are a few reasons, and one of them is the addition of Pentacop and various customer books acquired last year. Other factors, we have better capital raising capabilities, and there are definitely more activities in the first half, and of course the early unwinds of some structured products, and we experience continued growth in wholesale clearing and execution transactions in Morrisons. As for OPEX, the increase is mostly in line with revenue to 73.6 million. There were unexpected costs more than this time last year, cessation of JobKeeper payments, and increasing the company's claim provision. The underlying profit or EBITDA increased 8% to 5.5 million this first half. Historically, the EBITDA margin and revenue earned are stronger in the second half. So that said, the forecast for FY22 EBITDA is on track to achieve 15% growth on a year-on-year. The company's operating net cash flow pre-tax has improved by 30% to 4 million. The accumulated cash balance have been used to fund acquisitions and investments in the last 2 years. As per last first half, the cash conversion ratio is relatively high, and the company is able to convert most of its EBITDA into cash. This is a result of good working capital management, very limited capital expenditure, and by having an effective cost management process. Our goal is more than 8%. We aim to create greater shareholder value by growing revenue, increase OPEX at a slower rate, and ultimately profit margin in the coming years. I'll now pass you back to Gary.
Thank you, Lizzie. So I might just make a couple of comments about that in respect to the first half results. So as I mentioned earlier, $9 million of the revenue has been brought forward early, but that hasn't necessarily impacted. The other point is there's almost $1 million of abnormal negative impact in the EBITDA result this year. When you take into account those points that Lizzie made in respect to integrational costs, the lack of JobKeeper, putting some money away for future claims, and also not marking unlisted investments to market. So we've reserved, if you like, extremely confident that the 8% minimum margin on revenue will be met. And as the second half comes through, the shareholders will see that. So the very long-term goal that I've talked to shareholders about in the past is that by 2025 we want to have $400 million of revenue, and by 2025 that 8% would want to be the minimum expectation on that number. So I'm looking at 2025, 400 million revenue, $32 million EBITDA of that converting to cash. So at the first half result, 1.07 of EBITDA converted to cash, which is an exceptional result, really. It's higher than the estimate I'm saying today, but if we can continue to do EBITDA to cash at 1, that $32 million 4-year outward looking is the internal goal. I'll move to the next stage, and the in my opinion, to generate the sort of returns that we're talking about in any one of the types of businesses that we've got is very difficult. The financial planning market, the broking market, the documents market, the clearing market, the media market are all businesses in their own right that have low margins and need scale. The reason why we can be successful is because we are sharing the cost structure across 20 entities, all of them making a contribution to profit, but all of them small in their own right. But many of them, more than 75% of them, growing at very, very strong numbers. Potentially, there is 4 companies here, being wealth, professional services, equity markets, and direct investment that you could potentially have as 4 different entities. But at this days, and we are very early days, we're talking about being 100. So we're certainly well, and we're in the very early days of this transformation that we're looking to make with your company. But I think the secret sauce is having the 20 businesses all making a contribution, all interacting together to create what is the one mission. And that one mission, I'll repeat it. I don't want to be repetitive, but the one mission is to provide services to accountants, financial planners, and the investment community, so we can bring down the cost of advice and provide services to parties that do give advice. That is our one mission, and that is our sole purpose. And as I mentioned before, the Royal Commission and the tailwinds behind creating that service has now become equal, and that's the first time in my 30+ years that's been the case. I might just move to by divisions just to give the shareholders clarity on where we are achieving our growth and what the divisional goals of those 4 businesses. Within our licensees, So the three licensees that we currently have is Interprac Financial Planning, Interprac Securities, and Interprac Financial, Sequoia Wealth Management. We would like to have 800 advisors licensed by us and representing our brand by 2025. Currently, we're around about 400. The education requirements of the industry saw the number of advisors dramatically shrink in the last 12 months. Our numbers of market increased, but obviously as a number of advisors, 20% of the advisor network across the country disappeared, we stayed flat. But as a percentage of the market itself, we are growing, and the number of advisors that are talking to us about joining one of those licenses at the moment is the best we've ever seen. So we would expect in the next 10 months that said, we are still on the acquisition trail, and we are still looking for acquisitions of the type that we've done in the past, like we did with the Yellow Brick Road, like we did with the Phillip Capital Advisors, like we did when we acquired Libertas. We are still talking to numerous licensees that are struggling with margins because they don't have the scale and they don't have the other service offerings to provide their advisors, and advisors are questioning their ability to provide multiple services like groups like us. That's creating price pressure on them and an opportunity to potentially exit and be part of a wider group. In the case of Libertas and Interprac, where I come from, we offered equity to those partners. We will offer equity to a business that's looking to merge, but really what we're looking to do is offer cash a business that's looking to sell. We still are of the belief that trading at a group to parties who are looking to exit. Parties that are looking to merge and come along for the ride with us, we're absolutely open to that. In the case of Interprac, Libertas and the acquisitions that we've made in the past, almost every shareholder that we acquire, every one of those past owners continue to own shares, and in many cases have actually increased their holding in the company. So they truly believe in the long-term mission, and in fact, in their mind, like when I sold Interprac, we haven't sold it. We've just merged into a listed entity and we're still owners of our own destiny. So that's the message I'm looking to talk to some of those partners. Our corporate finance and wealth management business, we are looking to grow that part more now that we've got capability and scale. We have a stronger presence in the market for small companies and even larger companies to come to our corporate team. We're building out that corporate finance team in the last the profits will come. We're not afraid to think long term and invest long term, even though listed companies to provide short term performance. We are prepared to invest long term, and we've done that, and that will see increased performance in that particular corporate area in the next period. And I think you'll start to see the Sequoia brand more in the marketplace in respect to the equity capital markets area, and our name and brand offering high quality opportunities to our client base, whether it be the accountant, the financial planner, or our brokers or other AFSL holders. We're certainly not in the business to compete with other AFSLs. In all cases, we're actually about providing them a service. We're going to continue to acquire retiring advisors business, and by 2025, when I'm talking about that $400 million target, I expect to be 45% of that number. So I'm 8 to 10%. This is a low margin business, but a high revenue business division. And as you can see, without any acquisition, period. That particular business has grown 17.6% from the first half in the previous year, so a good result. The higher margin business, however, is the professional services division, and this business was a very small business 12 months ago, and we made some statements about how we would like to grow this business's revenue over the next period. We would like to provide services to 4,000 accountancy practice and financial advisors in this business by 2025. That's a very significant increase. But the current inward interest in this particular interest being in the documents, legal advice, insurance broking and SMSF administration. On this particular business is high. So we are definitely using our scale, and this is very much a toll road business, and the numbers of establishing for accountancy practices, the number of SMSF administration that we're offering the service to accountants and financial planners is growing. Our general insurance broking business is growing. We made the acquisition of Tag Insurance Brokers. The numbers are not necessarily, well, they're definitely not reflected in the half year results, but there was significant expense reflected in the half year. Expect further improvement in this particular division's EBITDA and the margin. And, we do expect, a significant increase in group revenue. So we're talking about $40 million revenue by 2025. So this year it's likely to be 10 million. So I'm talking fourfold 2025 and very high margin. So this is a very exciting part of our. The next area, I'm trying to get my slide to work, there we go, is our equity markets division. And this is where Morrison sits. 2 years ago, when Morrison's, there was some anxiety around us being a clearer. The Morrison numbers and the Sequoia Special Investment business continues to do extremely well. As I mentioned earlier, $9 million of that revenue in that particular number does come from unwinding early specialist investment products. The revenue growth is a little bit inflated in that area. It would have come anyway, as I said, in the second half. But the Morrison numbers in particular continue, whilst the overall ASX market turnover has reduced, the Morrison numbers have continued to increase dramatically. Our contract numbers are 60 or 70% year on year. We've gone $1 million of EBITDA in that business this financial year. So that's a massive turnaround. When people look at the sum of parts valuation of Sequoia, the Morrison business is pointed out with open markets and FinClear looking to come to market with, in one case, $100 million valuation, in the other case, potentially a $1 billion valuation. And when you look at the contribution that Morrison's is making within our business, I think it's a bit of a hidden asset that is not necessarily reflected on our balance. Value is quite low, but the growth is exceptional. The service is first rate, and we're winning a lot of third-party AFSL holders across to Morrison's on a weekly basis. I would expect this particular area to be quite similar to the wealth division, where I would expect 40% of group revenues to be coming from our equity market. 25. This is a higher margin business than the wealth area. Of 3.6 million for the half reflects, a very strong business, and I would expect it to continue to get stronger. Our direct division is a little bit our poor child. However, it is one of the divisions that I'm actually the most excited about. People talk about the need for more Australians to get advice and the need for more Australians to get information on financial services. The financial services industry doesn't really have like real estate does with, say, realestate.com. Not the employment industry doesn't have like Seek, Seek, and the car industry has like car sales. When people are trying to determine which of the 10,000 managed funds they should be considering, or which one of the 4,000 ASX listed companies they should be considering, or which one of that they might be considering in respect to retirement planning and so on, it probably isn't a market over the next 12 months period. And our current revenue is $2.5 million per annum, but I'm looking to increase that to $20 million by full year. We're investing, and we have invested heavily in the last 6 to 12 months of improving our back office and our technology and our media business so we can scale up this particular area to provide financial planners, accountants, the direct community, general advice community, a significant platform for information. And EBITDA margin on very small businesses is very high. As you can see, a 41% EBITDA margin on just $1 million of revenue in a half year is very exciting. Artificial intelligence, direct information is something the public are crying for. There's a lot of discount brokers. There's a lot of people buying Bitcoin. There's a lot of people investing no knowledge of. That is a major concern to us. We believe sound decisions rather than gambling on their financial future, and we intend investing and growing this particular area very aggressively over the next 12 to 18. As I said, I'm most excited. 2 years ago, we had a wealth business that was going well and professional services and direct division that we needed to invest in. We did, and they're now making meaningful contributions to the business. The next 6 to 12 months, we're going to be investing in the direct division, and you'll see us scale up and improve that, become a meaningful contributor to your overall business. Just finalising before I go to questions. The Sequoia Opportunity, as I touched on before, is all about providing advisors solutions and allowing them to take their professional knowledge out to the marketplace. There's 16,000 representatives in the industry at the moment across 2,000 AFSL licenses. Scale and the service required to support those advisors and the requirements and the needs of those advisors is significant. There's going to be an absolute roll-up of this particular industry, and I would like the superannuation industry did with small super funds. There would be a scaling up, and I would think by 2025 there'll be less than 200 AFSLs, and I think groups like us will be the solution because we can provide advisors premium advice. We can provide them premium compliance, we can provide them premium research, we can provide information, media, and all the services that we're looking to provide. And I think Sequoia is in a really strong position to be the leader. We are not aligning ourselves to product. We will not align ourselves to product. We're not going to be vertically integrated like some of our competition continues to be. We are going to be the solution for the advisor who wants to have impartiality and have a licensee that's supporting that. We also see the accountancy there's absolutely no doubt that the end client respects the opinion of their accountancy practice. An accountancy practice is looking to, again, become more meaningful for their client. The ATO has introduced a lot of online services so that people, more and more of that particular community can go and do their own tax returns online. So the accountancy practice has got to work out more ways to offer added value to their client bases and a relationship with groups like allows them to do that. In theory, there's no reason why Sequoia can't deal with every single accountancy practice in the country. Our shorter term goal is to deal with 3,000. We currently deal with 1,500. So we would like to double that, but there's absolutely no reason why an accountancy practice, every single one of them can't deal with us in some manner. And obviously the easiest touch point is to do the professional indemnity insurance for their practice, for them to buy. But, there's no reason why they can't deal with multiple services. There's currently $14 trillion of private wealth in Australia, and $6 trillion of that is in managed investments of some kind. As I touched on before, there's 10,000 different managed funds out there managing this 6.6 trillion, and the community and the financial planners themselves need groups like us to understand and to educate them on each one of those products. No one's doing it at the moment. Right across the board, we intend to provide a solution. We provide more content for financial planners, accountants, and the general community in assessing, the pros and cons of each of those managed investments, so that people don't buy investments off the shelf with no advice and get caught in unsatisfactory investments. My email is my name, Gary Kroll @sequoia.com.au. I'm very happy if any shareholders or interested parties would like to email they have or have a chat one-on-one. Certainly by email, we can certainly set up a meeting one-on-one if you wanted to. But I'd really like to thank the support of the shareholders and thank everyone for attending today. When we do AGMs live and half-yearly live, we often get very few people. This new medium of having online and getting direct questions is a little bit impersonal, but certainly gets more people involved. And I thank those who attended today, and thank you for being an investor. If you're not an investor currently, hopefully you are in the future, and we can keep on delivering the type of results that we believe we can. So no, thank you.
Fantastic. Thanks, Gary.